Let's check in with our next guest, Shana Sissel, CEO of Banrion Capital. Shana, so what do you think here? I mean, S&P up, 17, 18% year to date. Does that reflect kind of what we're seeing in terms of earnings, in terms of maybe Fed movement here, or is there room to go?
Well, I think earnings have been, relatively good. We've not seen, a stretch of disappointing earnings through this cycle. I think that's supportive of a strong economy. And I think that the Fed is going to look at the things it focuses on, which is employment, employment and inflation, and feel really comfortable that they can take a step back. And it's looking more and more probable that we'll have a soft landing if they maneuver through this correctly, because we do have such strength and earnings have held up just pretty well. So
right.
Do I think we have more upside from here? That's the question. I mean, how common and how used to it can we be to having 20% market returns year over year? That's just not normal.
Right, which begs the question then, do you sort of sell into any rallies at this point, or do you buy the dip?
Well, it depends what kind of investor you are. If you're a long-term investor like I am, you buy the dip. If you're a trader, then there could be some relative weakness in the fourth quarter, especially as we get through the election. And I think that for that reason, if I'm a trader, I might be selling on weakness and then buying back in as some of the technicals are more supportive. But as a long-term investor like myself, I am buying the dip 100% of the time.
What are you buying on those dips? Are we sticking with kind of the Magnificent Seven, the tech trade, or are you looking for value in what might be a broadening market?
Well, I'm certainly looking for a broadening market. I mean, that's a positive technical indicator. It's very bullish when markets tend to broaden and you see more participation across the board. But yeah, I can't tell you that I'm not buying NVIDIA today, down 9%. In fact, I think there's probably more downside as we kind of get through the news related to their subpoena. So that's stock that I would be adding to some risk assets. I like some of the cryptos. As you know, I'm kind of in that alternative space. So BitB and ETHW are my two go-tos to get crypto exposure. And then Apple is another name. So those are names, again, they're kind of sexy. They're kind of the risk on trades. But then I'm looking at names like Atlas Holdings, which is insurance, and AeroCap Holdings, which is, industrials. So I think there's opportunities across the board. But yeah, I think that the future still is AI, and when I can buy those names at a discount, I will.
So here's my question about the consumer stuff. So the consumer discretionary, and I take a look at, say, earnings today. The dollar stores, you'd think they do great in this environment. They just can't get it together. And then Dick's Sporting Goods actually raises its 2024 outlook. Are these names that are interesting to you, or do you need some more clarity on the consumer and the economy to care at all about these guys?
So it's really interesting because the guys who are doing the best in consumer seem to be those middle market guys, right? Like they're not really high end and not the lower end, which is unusual. You normally in economic cycles see, one of the two parts of the barbell are leading. It's either going to be the really high end stuff, or, as we go into recessionaries and the economy slows down, you see kind of the lower end stuff. But it's kind of the stuff in the middle that's doing okay right now, which I think is quite interesting. If I'm going to look at anything, I'm going to be focused more on the lower end. It's more defensive to me. If we do see economic slowdown, people tend to go down market in their spending. And so that tends to benefit like the Dollar Generals and the Walmarts of the world. So if I'm going to look anywhere, it's going to be there, but I'm going to be very careful about the valuations there. Because I think overall consumer discretionary is a little stretched. It's done really well throughout. And subsequently, it's not a place that I'm spending a ton of time. I think there's better opportunities value-wise elsewhere in the market.
Shana, just on the alternative side here, I'd love to get your thoughts on the private credit business. It's been such an amazing business to watch develop really over the last, 12 years or so coming out of the great financial crisis. How do you guys think about that? How do you get exposure to that?
So it's interesting because with interval funds, you can get access to private credit, the average investor. And there's private credit funds that are coming out all the time in the interval space. There's 200 plus interval funds, which are semi-liquid products that are regulated under the 40 Act. So the average individual can gain access, but they're not super liquid, and they give access to private credit for investors. We tend to use more of the private fund strategies, LP strategies that have an accredited investor hurdle. We just think there's more opportunity there. And I can only tell you what like the managers we work with say. So say a Pender Capital, which is real estate, private debt, or a Meriwether Group, which is lower to middle market direct lending. And what we're hearing from them is that demand remains extremely high for these non-bank lenders because access to capital remains difficult for small business, small and mid-sized businesses. So they're seeing a lot of demand. And when you have a lot of demand, the interest rate environment doesn't matter because you can kind of set your price. And so we're seeing that in private credit. I do think in private credit, what you need to be is very particular about where you're playing. There are areas of private credit that I think are very overbought, particularly the upper tiers of direct lending, mezzanine, and some of these huge players that raise billions and billions of dollars. You know, where you see the most money flow tends to be the area where you lose the potential for alpha. And so looking at smaller boutique players and people who are playing down market are the places where we're seeing the most opportunity because those markets are most difficult for businesses to tap capital-wise.
What do you make of the NFL approving private equity investments? Like, is that something you're into?
Totally into it. So now you're speaking my language because I am a massive sports fan. I grew up in a household where...
That's not my language, though, but I'm trying.
Yeah. So for me, I grew up in a household where on Saturdays and Sundays, if you wanted to watch TV on the one TV we had, you had to watch football because you had no other choice. My dad and my brother, that's what they watched all day, every day. And you just had to either join them or you just couldn't do anything. So I grew up watching football. I'm a huge football fan. I think this is a big deal. I think the democratization of sports is a major development that we're seeing super early. There's only a handful of sports rights funds out there and even fewer that were approved by the NFL. But the NFL is the last of the professional sports leagues to allow for private equity LPs to invest. I think that overall, this just makes the market for sports and the market for investing in sports even broader and brings more interest into the space.
All right, Shana, I got to ask you, who's your team in the NFL?
I'm from Boston, so I'm a massive Patriots fan. In fact, my fantasy football league team name...
Uh-oh, we lost you kind of there. Okay.
We hung there. We were waiting for it.
My fantasy football team name is Just Add Mayo.
Okay. Very good. Shana, thank you so much. We appreciate it. Shana Sissel, CEO of Banrion Capital there in Boston. And we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the